And this is one way that you can avoid that liquidity swipe getting stopped out and then the stock going right back in your direction. There's been times where I would enter a trade and shortly after it gets stopped out because I wanted to manage my risk just for the stock to reverse back in my direction. It's not a coincidence because the market attacks levels of liquidity, but it's probably one of the worst feelings when it happens to you. After experimenting with different strategies, I found one that allows me to take directional trades while not getting shaken out of my positions because of liquidity swipes. Today, I'm going to talk about what strategy that is, how you can set it up, and how you can apply it to your trading. The strategy we're going to be talking about today is called a vertical spread. I made this diagram so I can break it down a little bit for you because there's a few different types of vertical spreads that you can use for whatever scenario or situation that you're in. But we're going to break down the different types of vertical spreads. And then we're going to get into the platform and show you how to set it up, show you what your risk is, show you what your reward is, and how you can manage a trade like this and show you its true power. So today, we're mainly going to focus on credit spreads, but I'm going to explain the difference of credit spreads and debit spreads real quick. A credit spread is a type of vertical spread, but a credit spread is when you sell a position. So when you sell options, you're going to be receiving a credit for selling an option, and that is called a credit spread. Now, on the reverse, you can also buy a vertical spread, and that is going to be labeled as debit spreads. There's a lot of different terms people use for vertical spreads, and I kind of wanted to get a little technical with the vocabulary being used because it can be a little confusing. Because just because someone is saying they're trading a vertical spread, you don't know if they're trading a credit spread or a debit spread. You don't know if they're selling a vertical spread or if they're buying a vertical spread. And you want to use a credit spread or a debit spread for different occasions, depending on what's going on in the market. But for today's video, we're mainly going to focus on credit spreads in this side of the diagram. Because the left side of the diagram talks about selling vertical spreads. And again, the right side of the diagram is going to be talking about buying vertical spreads. And we can get into that in another video. But for starters, there are different names for vertical spreads, but we're going to talk about credit spreads today. And there are two different types of credit spreads, as you can see down here. We have a call credit spread and we have a put credit spread. One thing I want to preface before we get into this is the fact that a vertical spread is a naked call position or a naked put position. It's a naked option position while buying an extra option to hedge the option that you sold. And I'll give you a visual when we get into the platform, but that's what a credit spread is. It's just a hedged naked position. And there's a lot of benefits to trading credit spreads: lower buying power, there's defined risk on the trade, there's a defined risk profit target. Let's break down credit spreads. There's two different types of credit spreads. There's call credit spreads and there are put credit spreads. So a lot of times people may just refer credit spreads or call credit spreads or put credit spreads as vertical spreads in general. But I want to break this down because they can get confused with debit spreads, call debit spreads, and put debit spreads, because a lot of times people will use the vertical spreads interchangeable. These are both called credit spreads, and there are two different types of credit spreads. Now, there's a call credit spread and a put credit spread. A call credit spread is a bearish position. That's why we have this down arrow right here, because if you think about it, if someone is buying a call, that's bullish. So the person selling it to them may have the opposite directional bias. That's why when you sell a call credit spread, that's a bearish position. Now, if you sell a put credit spread, that's a bullish position, and that's why we have the up arrow right here. Because if you think about it again, if somebody's buying a put and they're expecting the option price to go down because they're buying puts, the person that is selling the puts has an opposite directional bias, and that's why when you sell a put spread or sell any puts for that matter, it's a bullish position. We'll get into the debit spread side, but keep this in mind. There are two different types of credit spreads: a call credit spread, which is bearish, and a put credit spread, which is bullish. Before we get into the platform, a few benefits of vertical spreads, specifically credit spreads, is the fact that time is on your side. You can make money if the stock price moves sideways, and you can make money if the stock price goes down if you sell a call credit spread, and you can make money if the stock price goes up while selling a put spread. But with both of these strategies, if the stock stays sideways within your expiration date, you will still make the maximum profit on the trade. So that's one edge when you're selling contracts or selling any type of option position. The stock price can go sideways, down a little bit, or up as much as it wants if you're selling a credit spread, or if you're selling a call credit spread, the stock can go up a little bit, it can go sideways, and it can go down as far as it wants. So you can make money in multiple directions when you're selling option contracts, and specifically a vertical spread, which we're going to break down a credit spread today. Now we're going to get into the platform, show you how you can set up a credit spread, show you which expiration date that you can choose, and the benefits of doing so. We're going to set up a vertical spread, specifically a credit spread on NVIDIA. And I just want to start this off by saying this isn't a suggestion to get long or short on NVIDIA. This is just purely for demonstration purposes. And NVIDIA is a beast. NVIDIA has been riding off the AI theme, the AI hype. So, I mean, NVIDIA could squeeze shorts out to, who knows, 450, 500, I don't know. Or maybe it's going to pull the rugs on longs, anticipating a further squeeze on NVIDIA. I don't know, right? I'm just using this as an example. But let's say for whatever reason, you think that the squeeze on NVIDIA is done. You think NVIDIA isn't gonna go above 400 by the end of the week. Let's be a little more specific. Let's say you don't think NVIDIA by the end of this next week is going to close above 400. So if that's the case, you'd want to put on a short position because you're bearish on the underlying. So what we would first want to do is we'd want to go and see if we can sell the 400 call. So what we do is go to our trade page. We would select the contracts that expire by the end of this week. I can open that up, and now let's go find the 400 strike, because we just said we don't think NVIDIA can close above 400 by the end of the week. So again, our left side are the calls, the right side are the puts. So now if we go down to the 400 strike and we go down to the calls, we want to sell the 400 calls, not buy the 400 calls, because keep in mind, if you buy the 400 calls, that's a bullish assumption. But if you sell the 400 calls to the person that's buying the 400 calls, you have an opposite directional bias. It's just like buying and shorting a stock. If you're getting long or buying a stock, if someone is shorting it, they make money if the stock goes down, and they lose money if the stock goes up. It's the same thing with options. So we'll sell the 400 call. And you can already see the buying power for this position is going to take $6,700 in buying power just to get in the position, right? And the max loss is unlimited. And you might think, why is the max loss unlimited? Think about it again. The value of an option can theoretically go up to infinity. The most the value of an option can lose, the most it can go down is to zero, right? Again, just like a stock. If you want to short a stock at $10 with one share, the most you can make is $10. But if the stock goes up to $100, you can lose $90. If the stock goes up to $1,000, you can lose $990. So it's the same case whenever you're shorting stocks. Now you might look, the max profit's $560. Why is that the case? Because the value of the option we're selling right now is worth $560, which you see it as $5.60 because with each option contract, there's a $100 multiplier. That's where the leverage kind of comes in for option contracts. But that aside, this costs $560. That's why that's your max profit, because if you sell an option contract at $5.60, what's the lowest that option contract can go to? Zero. What's the highest that the option contract can go to? Infinity, just like we talked about. So this isn't very attractive. I mean, the probability of profit looks pretty good. 78% chance that I'll make at least a penny on this trade, which would give me 100% profit by expiration. That sounds great, but I don't know if I can sleep at night knowing that NVIDIA could squeeze $20, $30, $40, $50 higher when my max loss is unlimited. That's where selling the credit spread comes in handy, because we can still sell that 400 call, and we can also buy the 405 call to hedge the 400 call that we're selling. And now you can see immediately the buying power is only $367 to get into this trade rather than $6,700, a dramatic decrease in buying power. Now, the max loss isn't unlimited, because when we're selling credit spreads or vertical spreads, these are also called defined risk strategies, or meaning your risk is defined on order entry. So if I were to enter this trade right now, the most that I could possibly lose on this trade is $367, right? I'm not saying you have to accept the max loss or you have to wait for the trade to get to max loss, but this is just the worst case scenario when you're entering the trade with one contract. So the max loss is $367 per contract, and the max loss is the max profit, is $133 per contract. So if I were to up this to two contracts, my max loss would then be $266, and so on and so forth. But again, buying that extra call hedges the position, and you can still see we have a pretty high probability of profit on the trade all else equal. All right. So let's say we were to send this trade through. How can I make money? So if I were to send this trade through, this would mean that at 400 by the end of the week, if it stays below 400, I would make this full $133. The stock price could close at 390 by the end of the week. Let's say for whatever reason, the stock price just consolidates the rest of the week. By the end of the week at expiration, I would still make $133 on the trade per contract. Or let's say the stock price goes up. Let's say the stock price goes up to 395 by the end of the week. I would still make $133, which is a max profit on the trade because the stock price closed below 400. The stock price could literally go up to 399.9999999 and I would still make 100% of the profit on the trade because it still closed below 400. So that's how the vertical spread works. As you can see, time is on your side because keep in mind, as all options get closer to its expiration date, they lose value. That's why when this contract, if it were to stay below 400 by the end of the week, which is the expiration date that we chose, it'd be completely worthless. Even if it went up to 399.9999999, because it's still below 400 and all option contracts lose value as they get closer to their expiration date. So all I'm saying is for this trade, you don't have to accept the max loss if you don't want to. What you can do is if you want to be like, I want to get out of this trade when this spread gets up to, let's say, $1.60. Let's say when this trade gets up to $1.60 or this spread that we're selling, I want to exit the trade. Why? Because if I sell this for $1.33 at $1.60, how much would I be down? I'd be down $27. So if I set my risk at $1.60 per spread, I'll lose $27, or my risk would be $27 to make $133. So that's how you can kind of manipulate the risk and reward how you want it. And you don't just have to accept what the max profit is and what the max loss is. This is just the best case scenario and the worst case scenario. I don't want to get into too much of the weeds on this video, but you can still actually make money on this trade if it goes up above 400 a little bit. And that's going to be our break even. And I'm going to show you how you can calculate your break even right now. And your break even is where you don't make any money on the trade and you don't really lose any money on the trade. You just kind of break even. And this is how you calculate it. What you would do, as I pull up my handy dandy calculator, you get the strike that you sold and you add the credit that you received on the trade to the strike that you sold. So if we were to sell this spread right now, that'd be $1.33 and I'm selling the 400 calls. So if I were to take 400 and add $1.33 to that, that's going to be 401.33. So that means on this trade by expiration, I would break even if it were to close at 401.33. If it closes at 401.32, I won't make my max profit, but I might make just a little bit of money, pretty much close to break even still, because it's pretty much at my break even price. But this is your exact break even, 401.33. And what I did again is I just took the credit that I'm receiving on the trade and I'm adding that to the call that I sold. So my true break even, not my max profit, but my true break even is at $1. Let's just move this. This would be at 401.33. In the intro of this video, I talked about how this really helped with liquidity swipes, you getting stopped out of your position just for it to go in your direction. And what I mean by that is, let's say you start getting short right here, and let's say you put your stop loss at the top of these highs, because that might indicate and tell you that maybe we're going higher. And a lot of times what will happen to a lot of traders is the stock price will come here, break the highs, they'll enter their trade, and then the stock will just dump on them. And that's what we call a liquidity swipe. And this is one way that you can avoid that liquidity swipe getting stopped out and then the stock going right back in your direction. Because again, if the stock expires or if the options that we're selling expire by the end of the week, I don't care what happens in between this. I know what my risk is on the trade. It doesn't matter if the stock price is doing this, doing whatever it wants to do. If the value of my contract is still where I want it to be, I'm not going to be letting the stock price determine whether I enter or exit my positions. I'm going off of the value of the contracts. So I don't care if this comes up and sweeps me, stops me out, and then goes in the direction that I want it to go in. I don't care about that, because I'm not trading the stock price itself. Yes, the stock price influences the value of the contracts, but the stock price itself isn't fully what influences the contracts. So that's one thing to keep in mind. Using this directional strategy has helped me from getting stopped out of many positions. And another thing you can do is you could even sell the 405 contracts or the 410 contracts if you wanted to. It's just you wouldn't be collecting as much credit if you go too far away from the strike price. For this reason, you can always get your directional bias and find whatever strike you want to sell based off of the charting. I hope you learned something new today. Whenever options become more popular within the next few years, because of all of the option knowledge now being put out for people to consume, the vertical spread is probably going to be one of the most popular strategies to use because it's pretty simple. Your risk is defined, your profit targets are defined, and also time is on your side for these type of strategies. So if you ever get caught bag holding a little bit, the time value is going to work in your favor because of time decay. So I hope you enjoyed today's video, and I'll catch you in the next one.